The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hello again, this is Jonathan Blau, host of the Crazy Wealthy Podcast. Today we're actually introducing the version of the Crazy Wealthy Podcast called Fix It Fridays. And it's a very concise, short version that's just going to be me helping to identify some of the biases, which are systematic errors that we all make in making decisions, particularly decisions about money under conditions of uncertainty. And the term fix it is really just because we're identifying a systematic error that we're all, by human nature, prone to make, how to identify it and how to fix it. So we thought, what better thing to call the short version of these podcasts, Fix It Fridays. And they'll be coming out. Our plan is every other Friday. So this will be the first Friday, and expect to see it on our LinkedIn site, Facebook, our website, fusionfamilywealth.com, on an every other Friday basis. And so again, welcome to the first episode. What I thought would be interesting to talk about on the first episode is biases and mistakes about money and uncertainty kind of may only be viewed to impact people who might not be sophisticated investors. And I've always said we have a reflexive association between wealth and wisdom, particularly when it comes to money decisions, and particularly when it comes to investing. What I mean by that is we automatically assume that if somebody's successful in business, that would translate, because they're wealthy and successful and proven, so to speak, in business, that the skills that led them to be successful in business, in their mind and the outside world's mind, should definitely lead them to be able to be successful investors. And in my experience, nothing could be farther from the truth. And in fact, the wealthier, more successful we are, we tend to need behavioral counseling even more for two reasons. One is we because of our success, we develop what's called overconfidence bias. And what that means is that it's kind of like if you ask 100 drivers in a room, how many of you consider yourself to be above average? More often than not, close to 100 hands go up. By definition, only half the room could be above average. And that's how we think of ourselves. So when we're successful, we tend to get overconfident in our abilities. And so that overconfidence bias acts like a magnifying glass, meaning that human nature and the mistakes we make about decisions and money are pre-programmed into all of us. And human nature is immutable, doesn't change. We all react to fear, greed, envy the same way, regardless of how well educated we are. We're human beings. And when we are overconfident, overconfidence is like a big magnifying glass that we hold over all those biases that we're prone to just as much as everybody else, but we're magnifying them by an order of magnitude because of our overconfidence. So one of the first examples I'll give is entrepreneurs who are successful and executives who are successful are oftentimes running businesses that have multiple divisions, and they tend to look often quarterly at the divisions, and they'll say, gee, these two divisions are doing poorly for the last 2 quarters, so maybe I'm going to jettison them. I'm going to sell them off, close them down. I'm going to take the resources that were supporting those, what I call failing divisions, and put those resources into the divisions that have been doing really well, knocking the lights out. And that's good when you're managing a business in many senses. But when you're running a portfolio, an investment portfolio, that by definition is diversified. So, for example, might invest in large companies in the U.S. and small companies in the U.S. because they tend to do better than the other at times and to magnitudes that are unpredictable. U.S. companies versus international companies. And then there are two main styles of investing: value, which tends to find companies that are selling at a discount to what their fair value is, oftentimes because there's some problem with the company or industry that's short term, but investors treat as long term. So they sell off those companies thinking like the problem won't get resolved, and they sell at a discount. And then growth, which is the other style. Growth are companies that are selling at a premium to the average company because investors expect that the growth of their earnings will also be premium to the earnings of the average company. And so those two styles go in and out of favor at times. And again, magnitude's unpredictable. And so what happens is when an entrepreneur and executive who's used to jettisoning underperforming divisions and putting money into outperforming divisions, they tend to look at the portfolio diversification mechanics the same way, meaning instead of in the late 90s saying, wow, these tech stocks that I've developed a big exposure to because of how much they've grown look overvalued, and the international emerging markets stocks look undervalued. They haven't done much in the last 8 years going into 2000. So let me buy more of the emerging markets and let me sell some of the expensive. That's not what they do. What they do is they look at the sectors that are meant to diversify each other by performing differently than each other at different times. They tend to look at them at divisions. So let me get rid of the emerging markets because it's a bad division. It's not an undervalued sector in my diversified exposures. And let me take the proceeds from that and pour it in at the very top of market valuation to the division that I have, the technology, large companies in the U.S., Lucent Technologies, AOL, et cetera, back in 1999, and let me put all the money that I get from selling the undervalued division instead of the division that I look at in business that's not performing well, the undervalued division. Let me put it into the overvalued division, the tech stocks, just in time to go into the next decade from 2000 to 2010, where emerging markets, as in this example, made 200%, and technology stocks lost 60% for that decade. So it's a big mistake that we make as entrepreneurs and executives who are successful and used to managing their portfolio the same way they might manage the business. The other thing that's a challenge for entrepreneurs and executives who are successful is that they tend to, particularly in the case of entrepreneurs, need skills to build their companies and their wealth from entrepreneurship that are not just different than the skills needed to succeed as a long-term investor, but oftentimes the skills are opposed to them, meaning that entrepreneurs to succeed go all in, take all their skills, all their energy, and all their money and put it into oftentimes one big idea. And they ride it, and if it were, and it's against all odds of success usually, but they succeed in some cases. And so in order to succeed as an investor, you need to do the opposite. You need to not concentrate all of your energy and money into one company or sector, but to spread it out and diversify. The goal in investing is not to find what's the best for you, highest returning business I can invest in and borrow maybe to invest in, but what are the best returns I can find that I can likely stay with for multi-decades? Because compounding is just return to the power of time, where time does all the heavy lifting. So investors need to be patient and disciplined much more than entrepreneurs do. So thinking that our success as entrepreneurs and executives is translatable into success as investors, not only is in my experience untrue, but oftentimes the overconfidence that we develop because of our success as entrepreneurs and executives leads to worse and more costly behaviors when it comes to money and uncertainty. The other thing I'll say is and I'm an entrepreneur who's successful, fortunately, so I relate to it. We tend not only to be overconfident, but we also tend to attribute much less luck to our success than skill. The causal relationship of skill is something that we often always look to account for our successes. We only look to luck when we don't succeed. We look to blame an outside factor, and that leads to not learning from our mistakes and so forth. So when it comes to investing, all you successful entrepreneurs and executives out there, don't discount the benefits that you might get from listening to our podcast and learning some of these biases. So hopefully you enjoyed the first episode of Fusion Fix It Friday. And if you want to access the episode, you could go to fusionfamilywealth.com, podcast section, and also the episode will be available on all the major podcast channels like Apple and Spotify, etc. And of course, you can go to crazywealthypodcast.com as well. So thanks again for tuning in. Look forward to seeing you on next Fix It Friday in a couple of weeks.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or is a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.